Good morning, good morning, good morning, and welcome to Talking Money in the Mornings. I am your host, H Cortez, financial health mentor to the working class, where I do my very best to bring practical, proven wealth building strategies to working class men and women all over this great nation of ours. Today's show, we're going to be talking about investing wholesale versus investing retail. Now, I will be the first to admit that I am not an expert in these subjects, and I'll go ahead and give you my disclaimer. I am not a financial planner or a licensed financial specialist. What I am is a financial educator, and what I'm bringing to you are the facts that I know from what I've been taught by my mentors who are 7, 8, and 9-figure earners in the financial services industry. And I listen to people who are where I want to be and who have done things that I want to do. So what I'm sharing with you is personal experience through my own research. This is not in any way to encourage you to invest according to my personal beliefs and my personal study. So again, welcome to Talking Money in the Morning. I am so glad that you decided to hang out with your boy. And I'm going to share some information with you that hopefully will start you on a path to researching, start you on a path to finding mentorship that will help you in your financial journey to achieve whatever financial goals that you have set for yourself. And what I like to say is that this show is for those who rise and grind every morning, those who are looking to build a legacy for their family, those who want to go to another level in our finances, those who don't believe that there's anything wrong with being wealthy, right? This show is not for the person who has issues with money. Believe it or not, there are a ton of people who really have issues with money. Don't believe that believe that there's something wrong with aspiring to be financially secure, wealthy, rich. I don't know if you ever seen what a future billionaire looks like, but you're looking at one. And I'm not ashamed to say that. I don't think that it's vain, and I don't believe that money becomes my God because I want to become wealthy. But I do know this: if you're going to go after anything, then you're going to have to study that thing and how that thing works. And I study how the money game is being played, and I teach that to those who follow me. So hopefully you can appreciate what I'm talking about here. This is all for those who don't have a problem with wealth, riches, and I know that some people have a psychological issue with money, and that's why they repel money away from them versus attracting money to them. So before we get started, I want to give you my morning announcements, and today's morning announcements are brought to you by Young Biz Kids. Young Biz Kids is an organization here in St. Louis, Missouri. And basically, they teach entrepreneurship to children. So they have an event coming up August 6th. I believe it's from 10 to 4, and it's going to be a Young Biz Kids marketplace where the young business owners set up shop similar to farmers market style, and they get to sell their products and services, practice their skill, and interact with adults who they're trying to appease with their products and services. So if you have a chance to come out to do that, then definitely do that. So that is one of the major announcements that we have is come out to check out Young Biz Kids. The details will be below the time, place, and location. Also, there is a small business expo going on at Qtopia here in St. Louis, Missouri. It's basically a little bar and grill. And there'll be 15 to 16 different small businesses there coming together to network with each other and also with the community and show the community what it is that these young business owners have to offer, guys. It's the young business owners that make the economy go. So come out and support your local young business owners. That's going to be August 27th, I believe. I will have the accurate details in the description below. It is a Saturday, and it's from 1 to 4 p.m., and it's hosted by Verified, which is she makes berries and infuses them with alcohol for adult events, and then also by Sierra from C Bedazzle, and she bedazzles and custom fits all of your your little girls things from bows and all of that kind of stuff. So again, the morning announcements brought to you by Young Biz Kids. Go to youngbizkids.org to check them out. So now let's get on to what we want to talk about today. So if you're just joining us on Periscope or on YouTube, or if you're checking this out through my fan page, the best way to interact with the show is through my fan page. I'm going to, so if you go over to facebook.com/financial health mentor, that takes you to my fan page, and I can read the comments from my fan page. I haven't quite figured out YouTube Live and how to get the chat stream working inside of YouTube Live. So if you go over to Facebook, you can watch the show live right inside of Facebook, right there on your timeline as well, or in my fan page. And then if you have any comments, you can leave your comments right there, or questions, and I can get to that via Facebook. So sorry, we're going to get this thing figured out as it relates to the best way to interact with the show. But if you're just joining us, I'm H Cortez, financial health mentor to the working class. I'm an author, wealth building strategist, entrepreneur, and I love to talk about money. If you have a problem with money, this is not the show for you to be tuned into. In today's episode, we're talking about investing wholesale versus retail and what the difference is, and how you can take advantage of wholesale, because you get better rates of returns on your money when you do invest wholesale versus retail. But there's a couple issues with accessing the wholesale investment market, and we'll talk about that a little bit today. So what I did for today is I went and I researched. So we all understand the difference between wholesale and retail as it relates to anything else, right? When you go into a shopping a supermarket for groceries, right? We understand that that is buying retail, right? That grocery store talks directly to buyers and sellers and manufacturers, and they get those products that they sell into you, they get them at a wholesale rate. Why? Because they are buying in truckloads. Usually they're buying in bulk, right? You know, some people might say that, you know, the difference between Sam's Club and Walmart is kind of retail, wholesale. I consider that still on the retail end. You're just buying at a better price because you're buying more, but you're not really buying in mass quantities like you would be if you were dealing with a buyer or a wholesaler. So the banking system works the same way. What is an example of a retail banking establishment? That would be your everyday bank on the corner, your U.S. banks, your Bank of America's, where you go and do your deposits, your checking account, your savings accounts. That would be your local credit unions. Things of that nature would be your retail outlet when it comes to banking. That's why they're on every corner. But when it comes to wholesale investment or wholesale banking, then you think about your wholesale your investment bankers. That would be your Fidelities, your Vanguards, your Prudentials, your T. Rowe Prices of the world. Those entities would be what we consider wholesale establishments. That means you're going to get a better rate of return when you deal with those entities. Now, let's take, for instance, what the difference is and who's allowed to access those places. When you are shopping at a supermarket, the supermarket is set up for anybody to access a supermarket, right? They want customers of all kinds. Everybody, you can go in and buy one item, you go in and buy 50 items, but you're buying them at the retail price, right? On the wholesale end, then the wholesalers kind of don't deal with the general public. They deal with known establishments who are going to buy in bulk, right? So that the everyday average Joe can't go into a wholesale establishment and say, "Hey, give me a truckload of peas," for instance. You know, you want a truckload of peas. I don't know what you're gonna do with a truckload of peas, but you're not going to be able to go get that because, number one, you don't have the distribution capability to move those products, and the wholesalers want people who have distribution outlets so they can have repeat business. Right? Well, the banking establishment is set up the same way. Anybody can go and set up a bank account. It doesn't really matter who you are. Some of them do have some criteria, some credit unions, you check your credit and things of that nature, but that's the establishment set up for the general public. Here's what most people do not know, is that the wholesale banking establishments are also open to the general public, right? Anybody who has the money can go set up an account with a wholesale banking investment house, from T. Rowe Price, Fidelity, all of them. Here's the problem. To set up that wholesale or that retail, that wholesale banking account, it usually takes a significant amount of money versus when you go to the retailer. So the retailer will let you open up a bank account with $100, for instance. You're not getting that done on the wholesale market, because Fidelity, they understand that this is for serious investors. While they will allow anybody to come in the door, you have to be serious. And the way they prove that you are serious by setting a minimum requirement to come and invest with them, because most people, if you're serious, you don't have a problem forking over $3,000, $5,000, $10,000 to open an account. And that's how they buffer the real investors from those who are playing around in the investment game. But I promise you this, if you take the time to learn what it takes to invest on the wholesale side, you will get a better rate of return. So what I did for my research for today's show is I went out to nerdwallet.com, and some of the products that you will find at a traditional retail bank are products like checking and savings accounts, money market accounts, and CDs, right? So I went to look at, I didn't even bother looking up the national average interest rate of a savings account, because we know that that is way less than 1% rate of return. But here's the deal, man. And tomorrow's show, we're going to talk about the real banker's secret. And I'll give you a little heads up, as we will get deep into that tomorrow. But most people don't understand what a bank really is, right? We've all been convinced that a bank is set up as a place for you to safeguard your money, right? But I'm gonna give you a secret and tip you off to what tomorrow's show is going to be about. But a bank is a business like any other business, all right? And they are in the business of buying currency and selling debt. I'm gonna say it again. Banks buy currency and they sell debt. But the general public doesn't realize that they're buying the currency from two places. They buy it from the Federal Reserve, and they buy it from you, the everyday individual. So when you go and put your money in a savings account, they are buying your currency, right? See, anytime that there is an interest rate attached to anything, understand that a loan is taking place. So when you put your money in a savings account, that's why they always have to give you something, even if it's 0.2%. They always have to give you something, because a loan is taking place. So they are borrowing your money at 0.2%. They're going to take and invest it in the wholesale market. They're going to get 8, 10, 12% rate of return for your money, and then give you back the 0.2% that they promised you. Right? So when you understand that, then you don't fall for the games that they play. So they have you believing that you're buying products, but you're actually loaning them your money. So tomorrow we're going to get really, really deep into that on tomorrow's show, where we'll be talking about the real banker's secret. But on to today. So I went and looked up some of the national average rates of some of the products that you can get at a retail establishment. And then I went into one of the wholesale establishments' websites, and we're going to talk about, I'm going to show you some of the rates of returns that you can get by sharing the screen with you really, really quickly on what you can get versus these rates. So I went to nerdwallet.com and I checked the national average or for the highest money market rate. And Everbank had the highest at 1.11%. But the minimum amount of money that you have to invest is $1,500. And this BBVA Compass also had 1.10, but the minimum amount that you have to have in that money market account is $10,000. Guys, let me stop right there. We're talking about having $10,000 in a money market account just to earn 1.10%. But here's what the banks have done. They've pushed the regular savings accounts interest rates down so low that you'd be extremely happy to get 1.1% rate of return by having your money in a money market account versus a regular savings account. But you're here today because you want to learn about the wholesale investment market versus the retail market. So let's go on. EBSB Direct has 1.08%. Again, you have to have $10,000 over there. Able Banking, I believe that's an online banking establishment, 1.1%. And you can start that with as little as $250. And then you're talking about Capital One also has a 1% money market, but they want $10,000 invested or $10,000 in that account as a minimum. So we're talking about, literally pennies on the dollar, guys. In order for you to, you can see where that's going. If you simply use the rule of 72, and basically the rule of 72, it says you take 72 divided by your interest rate, and it'll tell you how long it's going to take for your money to double. So putting your money in a money market account at 1%, for instance, with Capital One, where they have a $10,000 minimum, is going to take you 72 years for that $10,000 to double to $20,000, right? So that's what you have to understand that you're getting into when you go into the retail establishments to purchase these products. Now, the other popular product that you can get at a retail establishment is the CD. So I looked at the rate of a 5-year CD and who had the best rate. So State Bank in Indiana, Chicago has a 5-year CD at 2.27%. But that's a $2,500 minimum. And then, of course, you have to leave your money in there for 5 years to get full advantage of that rate. eLoan has a 2.1 5-year CD, and that's a $10,000 minimum investment for that particular product. First Internet Bank of Indiana, 2.07. You can start with $1,000. Again, 5-year CD. Barclays Bank 2.05. There's no minimum with that one, which I guess some people say that's pretty cool. And then Kansas State Bank 2.05 with a minimum of $500. So again, you can buy these products from the bank, but if they told you that you were loaning them your money, then you expect a greater rate of return. But they have it flipped and make you think you're buying something. So now they can sell you on how good a deal that is, especially when they compare 2.7% to a 1.1% for a money market account. And then they compare that to a 0.5% of a regular savings account. You think that is a big upswing. But guess what? Whenever you're investing, you always have to account for inflation and taxes come first. So even if you're getting 2.27%, you still have to account for taxes, and you still have to account for inflation. So that's why my mentors have always taught me that whenever you're investing, you want a rate of return of 8% or better, so that even when you count for inflation and taxes, you're still getting a pretty decent return on your money. So let's real quick go to the Young Biz Kids screen share, and I will go over with you really quickly because we're running out of time already. These shows really go by fast. So we're going to go into, let's see if I can get to my, let's do this. All right. Then we'll go to the screen share really quickly, and I'm just going to point out a few things. All right. All right. All right. Give me 1 second. Can't get to where I want to, what screen I want to share. All right, let me try that one more time. Let's see. I really don't want to share the web. I want to share my slide deck. All right, guys, so I'm going to get with this technology sooner or later. Let me do it that way. But I really want you to see this. I don't want you to take my word for it. I really want you to see this in writing, and then I'll tell you where to go to find this information. Because it's powerful when you understand what is really out there. All righty. So sorry, Periscope, you won't be able to see the slides, but you can also jump over to, all right, let me see if I can get this thing working one more time. All right. All right, so here we are with what we call a municipal bond fund, and I went over to Vanguard and just pulled out some of their funds. So hopefully everybody can see my screen. And basically what you have here is, if you can see, this is just a municipal bond fund, and all that simply means is that this money is being loaned to municipalities, you know, small corporate cities. And basically, if you can see these rates for the lifetime of some of these bond funds, you can see you got a 5.07% interest rate, a 6.26, a 6.77, a 5.9, a 4.2, a 6.09, and I can't see what the last one says, but hopefully you can see this okay. But that's basically just a municipal bond fund, guys. And here's the deal: in order to get access to these rates, then most of these bond funds start at about $3,000. All right, and then some of them, if it's for a education fund, then you can start them with $2,000. But really quickly, I'm gonna move through this really quickly. And here's a government bond fund. This is money that is being loaned to the federal government, whether it's for a mortgage, whatever the case is. But notice the rates of returns that are available when you invest in these funds. Now, keep in mind, Periscope, YouTube, that any investment, there is some sort of risk, all right? But understand this, since inception for some of these funds, 5.7, 5.6, 3.2, 6.1, 7.8, 9.4, 8.23. Again, you have to bring some money to the table. That's where our income shifting program comes in. You can literally learn how to get your money where you want it to be via income shifting. If you want to know more about that, just go to our website, financialhealthmentor.com, put in your best email address, and I'll show you how you can clean up the money that you currently make to get yourself in position to be able to get into some of these wholesale investment houses and start getting some of these types of rates on your money. So that is a government bond fund. Now, again, we're talking about investments, and investments, you know, there is some sort of risk whenever you make an investment. A municipal bond fund has probably the least amount of risk. Government funds has a little bit more risk, but then you go over to stock funds. So let me show you what you can reap when you're looking at stock funds, right? You got an 8.9, 11.63, 13.45, 8.47, 15.9, 6.0, 10.3. See, a lot of people want you to believe that there's no such thing as a double-digit rate of return. Warren Buffett has averaged an 18 to 24% rate of return throughout his lifetime of investing. So don't fall for the investment or financial planner that says you should be happy with a 4% rate of return, because again, they understand the game. They know retail versus wholesale. So they will get your money, give you a better rate of return than you're getting from the bank. They will take your money, for instance, and invest in this bond fund or this stock fund here, get a 15% rate of return, give you the 4% they promise you, and profit on the 11% rate of return. So everything is about wholesale, retail. Even in banking, you have to understand that you can go to these banks, these investment houses, and get the rate of return and cut out the middleman. But here's the deal: most of these funds start at 10,000, 20,000, 50,000. So I'm going to give you really quickly. We'll go over. So I picked the one that was at the highest rate of return. That was that one that was at 15% rate of return, 15.9, almost 16%. And here are some of the details on that particular fund. You can see they rate it for risk, and it is a number 5 for risk. That means it is the most risky investment at all. That's why you get such a high rate of return. Some of those companies that the fund invests in could topple at any time. So, that's a volatile deal. So it could crumble on you. You'll see that the minimum investments, you have to have $10,000 to come to the table to get into this fund. It's a domestic stock. They small value. They invest in small capitalized U.S. value stocks. So small U.S. companies, they're funding, and those companies are borrowing money from this fund in order to run their operations. So guys, it's not terribly difficult to understand. And here you can see, the fund started in 2011, and it started low. So in 3 years, it was getting a 10% rate of return. 5 years, it was still a little over 10. And the 10-year market, it dropped down to 7%. And then, from the 10-year mark on to 2016, it back up to 15% rate of return. So guys, here's the other thing that you have to understand about the stock market. Yes, there are ups and downs, but you see the trajectory of this line. It is constantly moving upward. Even though it's scribbling up and down, up and down, up and down, up and down, overall, it's continuing to increase. So let me get out of the screen share really quick, come back to you guys live. Hopefully you guys understand what I was trying to convey there. Maybe on a different show, we will go specifically to, I'll do a full screen share show. If you would like to see something like that, comment in the link below, and I will show you how to get through that. I'll give you some definitions of some of the general terms that you'll have to understand going through a site like Vanguard or Fidelity, what you're looking for, the difference between government bonds, municipal bonds, and stock bonds or corporate bonds. And we can talk about stuff like that, but just understand there is a such thing as retail versus wholesale. If you get your money right, you can go into the wholesale market, cut out the middleman. It costs you actually less money for them to manage that money and manage your funds than it does for you to be dealing with a banking establishment or most brokerage houses. So understand that's the deal. And then when you understand that, you can take a look at your 401k plan and you can better manage that yourself, because you'll know more about some of the particular funds that are available to you, and you don't have to invest in the fund that your company sets up for you. You can manage your own 401k and get your money into some of these better funds that will get you a better rate of return. So guys, hopefully this made sense to you. If you have any questions, put your questions in the comments below on Facebook, on my fan page, Financial Health Mentor, or on the YouTube channel, Financial Health Mentor. Periscope, always a pleasure to hang out with you guys. So we're at the end of the show, and I just want to say this, guys. Whether you're investing retail or wholesale, get in the habit of investing something, all right? But if you got your money in some retail establishments, take the time to learn what it takes to invest wholesale, and then consider moving your money to some of these investment houses where you can get a better rate of return and make your money work for you a lot better. So today's show was brought to you by Young Biz Kids, a young nonprofit organization here in St. Louis, Missouri, that teaches entrepreneurship to kids. I'm super excited to be a part of that organization. And I love to promote what it is that they're doing, because I believe every child should know that entrepreneurship is an option and not just be funneled into a job. If you want to know more about how to get your money right through our income shifting program, go to www.financialhealthmentor.com, put in your best email address, and I will send you some information on our income shifting program, and you will see how you can systematically minimize taxes, eliminate debt, and ultimately free up the cash that you need to start investing in the wholesale market, because that's the two things that you need. You need the education, but then you need the money. I can provide you with the education, but you have to learn how to get the money to bypass the middleman and go directly to these wholesale markets. So we are at the bottom of the hour. You've been checking out Talking Money in the Morning with your main man, H Cortez, financial health mentor to the working class. Until I talk to you in tomorrow's episode, well, we'll be talking about the real banker's secret. I want you to get your money up, because you can do it. Peace.